Hi, Ben Kingsley here, and we're back in 2023 with plenty of key economic points to discuss in the year ahead. And we obviously are starting with a huge show. There is so much economic news to catch up on since our last update in early December. And in this month, I'm really going to be focusing on last year's global inflation shock and that we are past the peak, including here in Australia, even though it's not showing up in our December data. And of course, Australia's cash rate tightening cycle, it is coming to an end, led by consumers who are running out of cash. So let's jump straight into the data, starting with the center of the financial universe, the United States of America. Now, last week, all eyes were on the economic world as we centered on Jerome Powell and the Fed reserves for their cash rate decision, as they made a call on what's called the Fed funds rate. As we saw, the Fed Reserve raised the Fed funds rate by 0.25 basis points to a range of 4.5 to 4.75%. This move was widely expected on the back of very positive downward pressure on US inflation. I'll talk about that shortly. This is the 8th rise since March of last year. In his press conference, Fed Chair Powell noted that further tightening is required and that rates will need to remain restricted for some time. He noted that disinflationary process has started and that it is in an early stage and that the labour market remains strong. What is he talking about when he says disinflation? Well, I'm calling it early, but disinflation could be the buzzword of 2023. Now, disinflation is a term used in economics when inflation is falling. It occurs when prices start coming down for goods and services within the consumer price index basket of goods. By way of example, in the US, we saw the price of petrol, which on average peaked in June last year at $5 a gallon, tumbled down to $3.50 a gallon in today's market. Now, as more of the basket of goods and services that we see price reductions or even a slowing in price increases from month to month or quarter to quarter, disinflation starts to appear overall, which brings the inflation rate down overall. Now, he indicated that there was likely to be a couple more rate hikes to get to the level where he thinks is appropriately restrictive, were the words that he used. He also added that we are taking into account long and variable lags. We are thinking about that. So what he's meaning there is he's thinking about this lagging data read versus this sort of forward data indicators that he's got to help them make those cash rate decisions moving forward. And herein lies the challenge. They are trying to get the read on what is happening with inflation in the short to medium term as employments and wages in the US still remain strong. There is still a risk for inflation to remain stubbornly elevated outside of their 2% target for some time. And that's why he's signaling even more increases may be needed, as this ensures that the cash rate remains appropriately restrictive on the economy to keep putting downward pressure on inflation. And hence again, that means a couple more cash rate increases are still to come. Overall, his comments were interpreted by the markets as dovish, meaning positive for the markets. And that sent the US share market much higher as sentiment took a positive turn based on the potential that the US might avoid a recession and economic conditions overall might improve quicker than first predicted. History tells us that usually around 6 months, there's a 6-month gap between the final rate hike and when rates start getting cut again in the US. So a lot of economists are forecasting the US cash rate will start to fall by the end of the year. Yet to date, Jerome Powell remains consistent in his commentary and signaling that although the money markets are pricing in a rate cut later this year, he's signaling to the market this is unlikely for a couple of reasons. Firstly, he still needs the economy to slow down further, so he doesn't want businesses or consumers to get ahead of themselves. And secondly, employment is still very strong in the US. And with a strong employment, his job to get inflation to a 2% target level remains harder for him and his team to achieve. Let's take a closer look at the inflation numbers now. And we saw that the annual rate of inflation slowed for the 6th consecutive month to 6.5 in December. Now, this is the lowest since October of 2021. It still sits at 3 times the Fed's target range of 2%. Examples of the disinflation we see in the data include energy prices only increasing by 7.3% compared to 13.1% in November, and petrol prices dropped a further 1.5%. Food prices dropped from 10.6% in November to 10.4% in December. And in another example, used cars and trucks continue to decline, falling a further 8.3% in December off the back of a 3.3% decline in November. It's very clear now that the bulk of the supply side inflation shocks have moved through the economy, and this continues to show up in the lag data. Here's another good example of what I'm talking about. The cost of inbound air freight finished the 2022 calendar year at 27.8% lower, whilst outbound air freight ended the year 34.6% lower. On the demand side, as I mentioned earlier, the strong employment and wages growth story is the real focus in terms of how quickly inflation retreats, or whether it leads to a fresh round of inflation at some point in 2023. It's unlikely, but cannot be completely ruled out for now. Rounding out the update on inflation in the US, we saw the Producer Price Index, the PPI, a measure of input price inflation for businesses, declined 0.5% in December. Now, this was the largest monthly decline in the PPI since April 2020 and follows a 0.2% gain in November. Disinflation in food and energy prices played a major role. The read undershot expectations of a 6.8% gain. While excluding food and energy prices, the PPI gained 5.5% over the year to December, slowing from 6.2% annual rise in November. The slowdown in the producers' prices has now extended to 9 months and will continue to flow through to softer goods price inflation. That's further good news for the US inflation front overall. Looking at the GDP numbers, we saw the results for the US for the December quarter. We saw GDP expand by an annualized 2.9% in the December quarter. This was higher than the 2.6% that the market was expecting, but lower than the 3.2% recorded in the September quarter, signaling a slowing of the economy is underway in the US. It also reported that the slowdown was driven by softer consumer spending, exports, and business and residential investment. Looking at other key economic data in the US now, and we see a mixed bag of positive and negative signals. On the positive side, the employment data, the US added 517,000 jobs in January. Now, that's the most since July of last year and well above market expectations of only 185,000. This saw the jobless rate fall to 3.4%, the lowest since May of 1969 and below forecasts of 3.6%. Again, this is adding pressure to the Fed in terms of slowing the economy to drive inflation lower. Consumer sentiment, we saw the University of Michigan Consumer Sentiment Index rise to 64.6 in January from a 59.7 recorded in December. This was the strongest read since April of 2022 and was better than the 60.7 expected by the market. Now, on the negative side, we see retail sales. They fell by 1.1% in December, extending declines following a revised 1% fall in November. This was softer than consensus expectations, which centered on a 0.9% fall. The monthly fall was the largest since December of 2021, another sign that the economy is losing some momentum. Turning our focus to business activities, and we saw the Richmond Fed Manufacturing Index drop sharply in January, falling from a +1 in December to a -11 in January. This was below consensus expectations of a -5. New orders plunged -4 to -24 in the month. Businesses are also finding it hard to meet the existing orders they have as order backlogs fell deeper into negative territory and shipments also slipped. The manufacturing PMI came in at 46.8 in January, its third consecutive month of contraction. This was also above consensus expectation of 46.0 and was up on the 46.2 outcome in December. New orders were higher, whilst employment slipped into contractory territory. The services PMI also remained in negative territory for the 7th consecutive month at 46.6 in January. The reading was above consensus expectations of 45 and was up on the 44.7 read from December. Employment was also weak and dropped to its lowest level since October of 2022. The ISM manufacturing survey fell to 47.4 in January, indicating continued contraction in the manufacturing sector. The outcome was worse than the 48 expected by consensus and below the 48.4 result for the month prior. The result extends the run of contractory reads to 3 consecutive months. The Philadelphia business survey rose to negative 8.9 in January from a negative 13.7 in December, still maintaining a negative sentiment outlook. And finally, rounding out the US data, we'll take a look at some of the housing data now. Existing home sales fell 1.5% to an annual rate of 4.02 million in December. This is the lowest level since November of 2010 and marks the 11th straight monthly decline in sales, the longest such stretch since 1999. In year-on-year terms, existing sales fell 17.8%. New home sales increased to an annualized rate of 616,000 in December of 2022. This was the highest result in 4 months. It was higher than the 602,000 recorded in the month of November. Over the 2022 calendar year, an estimated 644,000 new homes were sold, 16.4% below the 2021 figures of 771,000. And finally, new housing starts decreased 1.4% to a rate of 1.382 million units last month and fell 3% in 2022 overall. For context, the number of residential properties in the US is around 145 million properties. So in summing up the US story, they are expecting 1 or 2 more rate hikes before a pause. The tightening policy is doing its job in slowing the economy, and inflation has for now definitely passed its peak in the US. Let's turn our attentions now to the People's Republic of China. Obviously, the biggest news out of China was the government's decision to relax their COVID zero policies. This decision, while sadly resulting in greater rates of COVID fatalities, from an economic and social harmony perspective, it will result in positive outcomes both in China and also the overall world economy. That's because China is deeply connected to so many supply chains across the world. So putting ample supply back into those supply chains will also push inflation lower. Looking at the latest GDP data that we saw, the quarterly GDP result was flat in Q4, showing no growth for the quarter. As case numbers surged and the economy experienced major disruptions due to the unwinding of the COVID zero policy. This is also off the back of a 3.9% increase in the September quarter, and the annual growth rate slowed to 2.9% in 2022. The inflation rate in China is still managing to avoid what Western countries' inflation spike that we've seen there, with the latest reading on inflation coming in at 1.8% in December, slightly up on the 1.6% reading in November. The unemployment rate sits at 5.5%, down from 5.7% in November. Retail sales fell by 1.8% over the year to December. This was above consensus expectations for a 9% plunge and followed a 5.9% drop over the year to November. The reason for the surprise on the upside was residents stocking up on essential foods and medicines as case numbers spiked. On the business front, we saw the official NBS manufacturing PMI unexpectedly increase to 50.1 in January of 2023 from 47.0 in the previous month, pointing to the first expansion in the sector since September last year and beating market consensus of a 49.8% reading, again on the back of the dropping the zero COVID policies. The Shenzhen China General Manufacturing PMI edged up to 49.2 in January 2023 from December's 3-month low of 49, but less than market consensus of a 49.5. The Shenzhen Chinese General Services PMI increased to 52.9 in January from a reading of 48 in December. This was the first growth in the services sector since August, buoyed by recent rollback of the pandemic curves and faster than expected peaking of infections. New orders increased for the first time in 5 months. In summarising the China's economic update, we can expect the Chinese economy will start to improve further in 2023 on the back of opening up people movements internally for work and for leisure activities, and also opening up their international borders. Europe's turn now, and we saw the economic story in Europe, as we discussed at the end of last year, wasn't looking great. As we were heading into a very difficult winter period with energy shortages and restrictions. So in real terms, it wasn't looking very great there for the European economy, obviously with Russia's invasion of Ukraine. But in the last couple of months, there's been some good news coming out of Europe. Firstly, that they did experience a more mild winter than usual. And this meant that energy demands haven't resulted in any severe restrictions or power outages. Secondly, after the initial scramble and demand spike in both oil and gas commodities, these prices have retreated significantly from last year's peak, and new supply deals that don't include Russia have also been secured as energy markets overall have settled down. So they are not out of the woods yet, but these are positive developments, and they have a positive impact in terms of the flows, in terms of lowering inflation and improving economic activity overall as we take a look into 2023. In fact, when we look at the latest IMF revised forecast, only the UK out of the G7 is forecast to go into recession in 2023. Let's take a look at some of the latest European data, starting with their interest rate story. Annual inflation rate in the euro area fell to an 8-month low of 8.5 in January of 2023, down from 9.2 in December and below the forecast of 9%. Inflation slowed in Italy, Ireland, and the Netherlands, but edged up higher in Spain and France. Also, core inflation, which excludes prices for energy, food, alcohol, and tobacco, remains steady at 5.2%, adding to further evidence that price pressures remain elevated in the Eurozone economy, but there are showing signs of abating. In January, energy prices rose at a slower pace, 17.2% versus 25.5% in the previous month, and services inflation also eased 4.2 versus a reading of 4.4 previously. Whilst costs increased faster for food, alcohol, and tobacco, 14.1 versus 13.8, and non-energy industry goods, 6.9 versus 6.4. Compared to previous months, consumer prices fell 0.4 for the same period as December, led by a 0.9% decline in energy costs. In terms of the latest data read, it's worth noting that the data from Germany's inflation is not available due to a technical issue with processing its data. So this inflationary story is still a little unknown right now, but hopefully, whilst high, they too appear to be out the other side in terms of the worst part of the inflation spike that they've seen in decades. So that's the inflation story, which obviously then leads into the interest rate story. And what we're seeing through the ECB from an interest rate point of view is they do expect to continue to keep increasing rates, but the outlook isn't as aggressive in terms of rate tightening. So let's see how that plays out over the next couple of months. In terms of GDP growth, the Eurozone grew slightly in the final quarter of 2022, growing by 0.1%, which eased from a 0.3% growth reading in the September quarter. The unemployment rate, seasonally adjusted, saw an unemployment rate was 6.6% in December 22, stable compared with November of 2022, and above market forecast of 6.5% a year earlier. The jobless rate was higher at a reading of 7%. Breaking down the unemployment rate across some of the bigger countries in the EU, we saw the highest jobless rates were recorded in Spain, 13.1%, Italy 7.8%, and France 7.1%, while lower rates were recorded in Germany at a reading of 2.9%. Looking at some of the outlook indicators, we learn a little more about the economic sentiment right now in what's happening in the Eurozone. So consumer confidence in the European Union saw an improvement of 1.4 points to still be negative 22.2 points. Consumers were more positive about the general economic situation of their countries, their future financial situation, and their intentions to make major purchases on hopes of lower energy prices and stimulus spending to help avoid a technical recession this year. Other confidence indicators in January also pointed to a more positive outlook. The economic confidence index rose 2.8 points to a reading of 99.9. The industrial confidence index rose 0.7 points to a reading of 1.3, and the services confidence index lifted 3 points to a reading of 10.7. So it's still early days in terms of whether the EU is turning the corner, and the threat of further escalations in the war between Ukraine and Russia will play a role in the sentiment and the actual outlook of economic activity if things get worse before they get better. And of course, any safe end to the war will have an immediate positive impact on sentiment and will further boost positive economic stories starting to emerge out of Europe currently. Let's now change our focus to take a look at the equity markets for a moment. And the reason why we wanted to have a look at that is because they're on a tear at the moment. So both the US and the Australian markets are booming post-Christmas. The ASX is pushing at record high, and the US market has surprised on the upside since the start of 2023, given most market commentators were predicting a very poor first half of the year for the US equity markets. In commentary circles around this latest rally, they are pointing to retail investors leading the rebound in the equity markets. Now, it's important to note that equity markets are always forward-looking, and this is a classic example for investors as they're seeing past the current economic story, including the current inflation spike, and thinking more medium-term outlooks for businesses' growth and also their profits. Now, as always, time will be their judge as to whether this will be a false dawn or whether we're over the worst of the economic slowdown as we look into 2023, 2024 and beyond. And that's how equity market investors normally look. It's worth also pointing out that when the share market's performing well, people's propensity to spend a little more as part of the whole wealth effect is also going to be interesting to watch as that plays out over the course of the year if the equity markets continue to rally. Rightio, let's turn our economic attention and our lens back into the Australian economy now. There's so much to talk about when it comes to what's happening here domestically. And we'll keep with tradition as we release this update on the first Tuesday of every month in line with the RBA update. And so we will share the RBA's decision today. At their first meeting of 2023, the governor and the board decided to lift the cash rate by a further 0.25 basis points, taking the current cash rate to 3.35. This is the 9th consecutive month that the RBA has lifted the cash rate and continuing the sharpest rate rise on record. Now, if you've been following my monthly updates, today's decision to move the cash rate higher meant that my prediction of a pause in February was wrong this time. However, it is worth highlighting, and for those of you who are really interested in this stuff, that the ASX website, they have a rate indicator page that shows the market predictions of cash rate movements in the month ahead. Now, at their reading on the 24th of January, as late as the 24th of January, the chance for a rate increase was only sitting at 53% versus a pause or no change to the cash rate sitting at 47%. Then the very next day, that prediction moved to 75% for a 0.25 increase to a cash rate of 3.35. And obviously that naturally meant that the chance of a rate pause or no change dropped from a prediction point of view down to 25%. So what happened on that day? Well, the latest inflation data was released. That's what happened. And I'll talk more about that inflation story later in this update. So I did get it wrong. But what it does mean, importantly, is that it means that we're 1 month closer to the cash rate pause, and I believe it will be coming soon. I've mentioned in previous updates that the RBA has been talking about trying to manufacture a soft landing. Now, with each of these latest cash rate increases, that likelihood gets less and less as we run the risk of causing a deeper slowdown than necessary. And with any deeper slowdown, getting the economic momentum up and running again is at greater risk. And this will take longer to achieve to restart the economy if we overcook it. Now, this must be playing on the minds of the RBA board. They must also be considering to take a pause sooner to gauge the full effects of the rate increases as they play out. Now, that tightening cycle has certainly got a lot to do in terms of watching that money flow through. And by pausing, that reduces the risk of overcorrecting and slowing the economy too much. Let's explore those inflation numbers now, shall we? And we saw headline inflation remained elevated in the December quarter, increasing by 1.9% in quarterly terms to a reading of 7.8% in annual terms. This annual rate is near its highest in nearly 33 years, yet it was below the RBA's forecast of 8% for inflation, headline inflation. Underlying measures of inflation increased by 1.7% in quarterly terms, taking the annual rate to a record high of 6.9. And this was the reason why we got another rate hike today, because the RBA forecast was for a reading of 6.5. Goods inflation is showing signs of easing, but services inflation, led by the recreation and culture group, was higher, and other service area inflation also showed up. Service inflation accelerated to 5.5% in annual terms, reaching its highest rate since 2008. Now, to give you some idea of the recreation and culture inflation impact, just in the December quarter alone, it jumped by 10.9% in the price of holiday travel and accommodation. Now, as a sidebar, I wanted to talk about two important things. Firstly, that a lot of households up until 2022 had accumulated a lot of household savings due to the COVID-19 period and those lockdowns. And so they had no real means for which they could spend that money. So we've built up this pent-up demand for vacations, and it's clear to say that basically households said, what the heck, we're going, even if the prices were extremely high for travel during that period. Now, secondly, and this is most important because it's forward-looking, we now see that households have scratched that itch. And last week we saw an update from Qantas's Alan Joyce, and he noted that airfares will start to fall in 2023. Now, that puts downward pressure on inflation in the recreation and culture sectors. And so as we also see a spike in immigration, which will mean that we'll also have more labour coming into that market. So what am I saying here? How do I summarise this? When the RBA is looking at that services spike inflation, but they're starting to think about that leading data indicators, not the lagging data indicators, which is the inflation that has occurred in the past, they will realise that the December's inflation result was a last hurrah as consumers tighten their belts. And there are a couple of clear indicators that further support that story, in addition to obviously Alan Joyce's story and also, the new labour that's arriving in Australia. So first of all, household saving ratios are now back to pre-COVID levels after peaking at record levels during those lockdowns. Now that surge of spending is coming to an end. Secondly, we see households with fixed mortgages are going to experience significant increases in their monthly mortgage repayments. Now, as those fixed loans expire, so their consumption is going to be impacted significantly by that. Consumer spending went backwards also in the December quarter. So we're starting to see that showing up in terms of household budgets. And finally, some economists are also still reminding us and reporting that as much as 50% of the current cash rate increases are still yet to flow through to household budgets impacting their spending. So if the RBA, what's my message here? If the RBA wants to land the plane safely via a soft landing, which is their term, any rate increase from this point forward does make that job harder, in my opinion, especially when we are seeing that inflation, we have passed that peak. I know it's not showing up in the data yet, but it's definitely past that peak. And so we're also starting to see consumers tighten their belts as well. Now let's have a look at the unemployment story, because obviously with more people employed, that does increase spending. So we've got to see what's going to be happening in terms of unemployment. And we saw that the unemployment rate held steady at 3.5% in December. Now, as November's result was revised up from 3.4 to 3.5, effectively meant that there was no change in the unemployment reading. Now, December recorded a fall in jobs of negative 14,600. Now, this is the first monthly decline in jobs in 5 months. The participation rate eased to 66.6 in December from a record high of 66.8 previously. Inside those numbers, we saw 17.6 thousand full-time jobs are being created, but we saw a decline of 32.2 thousand part-time jobs showing up in that data. So we are seeing a slowing in employment. Now, I want to explain that in more detail when you take a deeper look into that data. Employment growth over the course of 2022 averaged 37.7 thousand new jobs per month, with a total annual increase of 452,000, which is the biggest increase in employment in a calendar year on record. Certainly a great result for the economy indeed. But inside those numbers, we are seeing a slowing occur on the back of the RBA instigating this economic slowdown. Over the first half of 2022, there were 326,900 jobs added, whilst only 125,100 jobs were added over the second half of the year. So you can see a change occurring. But the story gets even more obvious that our record run of low unemployment is about to come to an end. And during 2022, the working age population increased by 436,000, which is also the biggest increase on record. However, in contrast to the employment gains that we just talked about, population growth accelerated in the second half of 2022, increasing by 231,000 compared to 205,000 over the first half of the year, which means more people will be looking for work, but there'll be less jobs available in 2023. Now, building on this theme, the current surge in net overseas migration will help bring demand and supply of labour into better balance over time, putting downward pressure on wages, which will please the RBA and reduce the risk of any wage price spiral event occurring during this current inflation wave. So in summary, there will be more people looking for work with less jobs available in 2023. Now let's, take that momentum and that thinking around the immigration story, and let's start to look at, that in more detail. So let's have a look at some of the immigration data that's starting to flow through. And so we saw that net overseas arrivals are expected to exceed 270,000 in the 2022-23 financial year via visa categories that add to the labour supply. Very important. These are categories that add to the labour supply. Now, that's 100,000 more than the best result of 167,000 back in 2008, 2009. Now, this will boost, this boost is coming in terms of work visas, skilled visas, and student visas. Now, overall net migration could top 335,000 based on some forecasts. Now, that's 100,000 more than the current federal budget forecast. But it is a real positive for the economy in the short to medium and longer term, remembering that total migration would include children and not just those coming for work. So that first number we said 270,000 was for those category work visas, but 335 when the family members and the kids also arrive. That's the net overall story. So based on some forecasts, economic forecasts, we see that the employment to population ratio and the unemployment rate could ease by as much as 0.5 of 1 percentage points. Further, up to 0.2 percentage points could be sliced off the services inflation. And most importantly, it will reduce the risk of unsustainable wages growth. I was talking to you earlier about wage price spiral. So that is also a healthy story. These new arrivals will not only help in the supply of labour, but they will also add to demand for goods and services, and of course, further demand for housing, most likely rents, but then ultimately become purchases later down the track. Now, one final and very interesting note about new arrivals to Australia, they tend to spend less and save more than the established residents. So again, this is actually good news in terms of putting upward pressure on inflation, or downward pressure, because they spend less, which ultimately means that there's no upward pressure on inflation as they settle in and start to save as they settle into their new lives in Australia. So that is a really positive story in terms of how that net migration is going to help us in several ways over the course of the coming 12 months and obviously into the next couple of years. Turning our attention now to consumer confidence and sentiment. What did we see in the data? Consumer sentiment started 2023 in a positive note, rising to 84.3 in January, an increase of 5% in the month. This followed a pretty somber reading of 80.3 in December. It still remains deeply pessimistic. We should always remember that. So anything above 100% is optimistic. Anything below 100 reading is pessimistic. And so even though it's risen, it's still obviously in pretty poor territory, but it is a rise to the highest level since September of last year. And it's also right across Australia in all states and across all sub-industries. Additionally, this was only the second consecutive monthly increase in almost 2 years. So we've seen a positive, just a little shift from very pessimistic outlook, where our numbers were as bad as, the global financial crisis reading that we saw back in 2008, 2009 periods. So that is a good news story. It will be interesting to see what today's cash rate does to this sentiment data next month, having received that increase. Economists are tipping weaker consumer sentiment is expected to flow through to further slowdowns in consumer and household spending as we move through 2023. Now, this is a perfect segue into retail spending and what we saw in the data. We saw retail sales, I mentioned a little bit earlier, they fell by 3.9% over the month of December of 2022, the sharpest fall since August of 2020. Some of the declines can be attributed to some Christmas shopping occurring in November instead of December. Over the quarter, retail trade grew by 0.9 over that December quarter. However, you need to remember this includes both higher prices and higher number of transactions. So this suggests that retail trade over the quarter could in fact be negative after adjusting for price inflation. By industry, there were falls across the board, except for food retailing that grew by 0.3 of 1% and hospitality services, which were flat over the month. Department stores, interestingly, turnover declined by 14.3% in December. Clothing, footwear, and personal accessories retailing declined by 13.1%, and household goods retailing declined by 7.8%. So what does it mean? Well, it's really clear. We are seeing the last, from the last update that I delivered back in early December, it was inevitable that spending would start to fall after the sharpest rate increases to households that we've experienced. And now that these savings ratios are coming down, more belt tightening is expected, especially when you combine higher interest rates, higher rents, higher energy prices, and higher living costs generally overall. And although that's not, for an economy, that's not usually good news, it is great news for now, as more businesses cannot take our custom for granted, and price pressures will start to appear on the downside, and that helps with the inflation story in the short term. And that's exactly what I've been talking about, why inflation has peaked. Those combinations showing up there. And again, that's a good segue and for us to now have a look at the business side of things to see whether they're getting the message, whether ultimately things are getting tougher for businesses, because that was a problem in the data at the end of last year where businesses were still feeling pretty good about themselves and business conditions were also in pretty good shape. So let's have a look at the business data. We saw business conditions decline for the third consecutive month in December, falling by 8 index points to be plus 12. Now, this was at the largest monthly decline in 15 months. So businesses are getting it. Over the December quarter, conditions almost halved, declining by more than 11 index points. They still remain above average, but the trend is definitely down. It's taken longer than usual for business sentiment to shift to a negative outlook, and that's because the tighter labour market, elevated household savings, and pent-up demand on the back of the COVID, that was then, but this is now. And so we are definitely here now in terms of starting to see that slowing of business confidence and business activity. In terms of the trading profitability and unemployment sub-indexes, all pulled back. Leading indicators like forward orders, capacity utilisation, capital expenditure intentions were all in decline. Then we look at business credit growth is also slowing. It's definitely showing clear signs of deceleration. Business credit grew by only 0.3% in December, the lowest monthly expansion since April of 2021. In annual terms, business credit was 12.9% higher than a year ago, but after recording a peak of 15.1% in October of 2022. So we're past the peak. Now, this is consistent with businesses reporting softening in conditions, an increase in capital utilisation, and a pause in their intention to expand and invest in capital goods. Business credit is now clearly in a downward momentum. In terms of in other business data news and in positive sign for inflation, cost pressures continue to ease from their 2022 peaks. Growth in final price and inputs such as labour and purchase costs were weaker in the month, reinforcing that, again, inflation has peaked. And this will start to show up in the data in the next couple of months as I've been labouring. In summary, the latest round of business data provides a clear indication that business conditions and confidence have pulled back significantly in late 2022. Business conditions are likely to continue to slide as economic activity slows, in line with economists' forecast, and well below trend growth, where some economists are forecasting growth in the year of only around 1% in terms of GDP. Now, if the RBA want to thread the needle, I'm coming back to the RBA story here, if they want to thread the needle with a softer landing, it must include keeping businesses upright and businesses investing. Further cash rate increases for this point forward, without taking a pause, puts them at a risk of overcorrecting the economy too much, which in turn causes business closures and or greater staff layoffs, which just takes so much longer for the economy to start moving again. Just think of it as a big flywheel. If you slow it down too much, that momentum takes a lot longer for businesses to start that investment program, to start re-employing people. So again, if they want to thread the needle with a soft landing, then they need to pause. If the economy keeps moving too quickly, they can continue to keep lifting rates later. But that's my view in terms of they at least need to take a pause, because any further increases is really going to put a lot of pressure in terms of slowing the economy a bit too much. Now, turning our attention now to all things property, as we hit our final conversation point for this particular update. And there's a fair bit to talk about here as well, which also supports the story of a slowing economy. We've seen in construction news, we've been reporting all last year about the increases in cost to construction of property. Now, this was backed up by CoreLogic's release of their Cordell Construction Cost Index, which rose by 11.9% in 2022. The really pleasing news, and again, news that supports peak inflation, has passed, was that the rate of growth in the index was only 1.9%, which was less than Q3's figure of 4.7. So 1.9% quarterly increase in the December quarter versus Q3 was 4.7. So it's definitely starting to slow. And so in this report, they talked about labour shortages persisting and some volatility of prices in some materials. But most importantly, that this pricing volatility was expected to ease during 2023. This also supported by the data showing a 41% drop in dwelling approvals since moving through historical high of March of 2021. Looking at the building approvals, we saw the rate of new private sector dwelling approvals has been steadily declining from the peak in early 2021 when the Home Builder government program finished. They have not been helped by surging materials and labour costs in the construction sector, and now rising interest rates have zapped demand for new houses. Private sector house approvals fell 2.3% in December. New house approvals have tumbled 37.5% since their peak in March of 2021 and are now running below the average rate of the past 10 years. Private sector multi-density approvals did surge, surprisingly, in December at 56.6 reading. But remember that this data does fluctuate up and down quite severely month to month. The 3-month moving average reveals that the gradual slowdown has also been underway in multi-density building approvals since peaking in May of 2021. So in summary, when we're talking about construction and we're talking about building approvals, the slowdown is likely to persist for some time on the back of a slowing economy and until something happens in regards to interest rates. So that is a real negative in terms of the supply story when it comes to future property supply. Household lending, now we look at that values, and we saw that the value of new house finance, excluding refinances, declined by 4.3% over the month to December. Both new lending to owner-occupiers down 4.2% and investors down 4.4% contributed to the monthly decline. In annual terms, new housing finance was 29.3% lower than a year ago, the sharpest annual decline since records started in the early 2000s. So that is telling you that the property market is definitely slowing down. Looking at owner-occupied standalone, new housing finance was 29.8% lower than a year ago, and that's the sharpest fall since March of 1986. Now, for context, back in the early 1990s, on the back of record high interest rates and recessions that we had to have, that decline occurred back then, and that was closer, sort of to 20% decline. So you can see here, it's quite an interesting position that we've got, where new house finance was down almost 30%, but during that record high inflation levels and a deep recession that we had, they only got down as low as 20%. New finance for construction for properties and to buy new properties is at its lowest level since 2020. This point to continued weakness in construction, putting downward pressure on cost to build and also downward pressure on supply. Refinance activity remains at close to record high levels, sitting at 18% higher than a year ago. Refinancing activity for both owner-occupiers is up 21.2% in annual terms, and investors is up 11.7% in terms of its increase. I expect refinancing activity to remain elevated as higher interest rates continue to bite and more fixed rate mortgages roll out from their fixed rate term into variable rates. On this point, refinancing would be even higher if it wasn't for restrictions currently in place or enforced by APRA. Now, I want to explain this because this is a real bugbear of mine at the moment. The APRA has a 3% buffer rate enforcement. Now, what that means is if I'm with an existing lender and I've got a fixed rate of 2.99, for that existing lender to do a servicing calculation to switch me over to variable rates, they use the 2.99% fixed rate plus the 3% buffer. So that means the servicing rate is 5.99 for that particular lender. However, if I want to look at refinancing, say, to a better deal, I cannot use the the same existing rate, generally speaking. So by way of example, let's say there's a better deal with a nice cash back and a cheaper interest rate. So I want to move from my existing lender to that better deal. Currently, APRA is restricting that because how it needs to be assessed from a serviceability point of view with that new lender is, let's say that the interest rate is 5.09, I've got to add the 3% buffer rate to that. So the servicing rate that I have to do going to a new lender is sitting at 8.09, but the servicing rate that I have to do with the existing lender was sitting at 5.99. So it's completely unfair. And so that means that obviously with most of the lending with the big four banks, it means that those big four banks will most likely retain those customers as opposed to refinancing to a better deal. So it's quite frustrating. I've been quite public about my frustration with a particular policy. We have seen some comments that they are aware of this, but they haven't done anything about it. So it really does get me quite irate in terms of all of these households, especially the ones who have bought property recently, first home buyers, and they've obviously taken out a big loan, and refinancing to a better deal or lowering repayments is going to be really important to them for managing their increased cost to the household. Well, they're not going to be able to do that based on this current policy. So it really is putting those people in mortgage jail, and that's affecting, in my view, the most vulnerable who are currently owning property in the mortgage market. So again, I'll continue to keep arguing that point until APRA removes that and brings in a more sensible assessment rate. And that sensible assessment rate probably needs to be around that 6.5 to 7% overall. Whether they use a floor rate or a buffer rate, I don't really care. But ultimately, from my point of view, it's definitely a problem, and it needs to be addressed, because APRA's job is to protect the financial markets. But if you collapse the property market, you won't be protecting anything, because basically the banks are so reliant on the residential property market. So they could be the cause of the problem rather than the cure for the problem. All right, so now I want to talk about property prices and the results that we saw throughout January. But I do want to put a caveat on this, and to say that Bryce and I will be taking a deeper dive into the risks and opportunities in the 2023 Property Market Outlook podcast that we'll be doing on Thursday. So I won't be taking a deep dive in terms of the outlook for 2023. Bryce and I will be doing that in a couple of days' time. Looking at CoreLogic's home value index, we saw a further fall of 1% in January. Now, that's a slight improvement on the 1.1% decline recorded in December, and it's the smallest month-to-month decline since June of last year. So we're still seeing basically a landing or an easing in terms of the rate of declines that we're seeing. Now, the reduction in the rate of decline was evident across most capital cities, except for Adelaide, only -0.8, and Perth, only -0.3. Where housing values have held firmer since interest rates began to rise in May of last year. Nationally, or in May or March, I can't remember. Nationally, home prices have fallen for the 9th consecutive month. And now, let's not forget that's on the back of obviously the fastest increases that we've seen in national home values on record post the COVID lockdowns. Let's take a look at some of the changes that we saw in those numbers. So Sydney was down -1.2 for the month. Melbourne was down -1.1. Brisbane was down -1.4. So their correction is quite significant at the moment. Adelaide 0.8, Perth 0.3 down. Hobart, this is by far the most significant correcting market, down -1.7. They again continue to have strong headwinds in prices in that market. Darwin down -0.1. Canberra down -1%. So combined capital cities, a -1.1, and combined regions are down -0.8. So, I did want to put that into context because I think sometimes it does get lost in terms of the noise. So let's just do a quick recap in terms of where we're at from the COVID trough through to COVID peak, and then the decline from the peak in those markets. So Sydney, from trough to peak, increased by 27.7%, has now given up 13.8% of that. Melbourne increased by 17.3%, has given up 9.3%. Brisbane, 42.7%, has given up 10.7%. So again, even though it's on a steeper decline, Brisbane and Southeast Queensland, you've had a bonanza. There's no way known that you'll see all of those gains be retreated. We'll start to see that softening shortly. Adelaide, 44.7, another fantastic trough to peak result during COVID, is only down 2.1%. So incredible story for Adelaide. Perth, 25.9, up, only down 0.9 of 1%. So it really hasn't moved at all, and is a really good market for 2023. Hobart, 37.7, so terrific result in terms of growth, is off 10.8%. Darwin, 31.1, only down 1.3, and the ACT, 38.3, down 8.6 off those peaks. So still a lot of buffer in terms of the amount of growth that's been had. And as I said, as we start to see, as soon as the rates pause with the RBA, we're definitely going to see some more interest and demand increase in regards to the property market then. On the rental front, national annual growth in rent values was 10.2% in the 12 months to December. This was partially driven by growth in unit rents across Sydney, Melbourne and Brisbane, where rents have increased by around 14 to 16% annually. Let's not forget that during COVID, they dropped by 20 or to 25%. So they're certainly recovering strongly from those declines. Through December, Australia's gross rental yield rose to 3.78%, up from a low of 3.21 in January of 2022. Over the 2022 calendar year, gross rental yields across the capital cities rose faster across Sydney, up 72 basis points. Okay, so let's close out what has been a mega update. If you've hung around to this point, thank you. Hopefully you've got a lot out of it, but I just want to summarize my key takeaways and food for thought as you think about your actions for 2023. The inflation peak is behind us. The data will start to show that story. In terms of all leading indicators are pointing to further weakness in the inflation rate. That's happening now, and again, that CPI data read will basically show that. In terms of what does this mean? It means that we're closer to a pause. As soon as we start to see that inflation, we want to see the impact of all of those rate tightening that's already happening. So we are closer to that pause, and the closer we get to that pause, the softer the landing we should be able to see in terms of the broader economy. What happens next for property prices? Well, once we get that pause, there's obviously that is a talking point. And so again, a reminder that this Thursday in the Property Couch podcast episode, Bryce and I will be taking a much deeper dive into those risks and opportunities in the property market in 2023. And so I look forward to your company for that particular update as we take that deeper dive. But until next month, in terms of the economic and RBA update, just remember, knowledge is empowering, but only if you act on it. So bye for now.